Picture a pristine, quiet cul-de-sac. 15 perfectly identical houses, manicured green lawns, a basketball hoop leaning against a garage. Every homeowner on this street pays their property taxes on time. They believe those payments are funding their town's survival. In reality, they are making minimum payments on a massive 30-year ballooning debt that none of them signed up for. A civil engineer who spent years designing streets exactly like this one decided to run the actual infrastructure accounting on his own neighborhood. This diagram compares the tax revenue from every house on the block against the physical cost of the pavement. It would take 37 years of capturing every cent of property tax to repay the road. And that doesn't account for the schools, fire departments, or water plants the town must run. If the maximum tax revenue of a neighborhood cannot cover its own physical existence, the town is surviving on a hidden financial ledger, one that carries a mounting shortfall toward a generation that hasn't arrived yet. The entire post-war American suburban build-out rests on this foundational financial pattern. Municipal engineer Chuck Marone discovered this glitch after realizing the road projects he designed were generating negative financial returns for the towns paying for them. When a developer builds a new subdivision, the town gets an immediate cash windfall. Permit fees, hookup charges, and a fresh stream of property tax revenue show up in the current budget, creating an immediate sense of prosperity. Brand new pipes and roads require virtually zero maintenance for decades. The town books the revenue now and defers the inevitable replacement costs 30 years into the future. Municipal accounting records this cash as a massive profit this fiscal year, even though the infrastructure itself is a long-term liability. This produces a dangerous illusion of wealth in the present, directly traded for enormous, unpayable obligations in the future. Low-density suburbs have a structural limit. Once the neighborhood is built, it cannot generate more tax revenue per acre to cover the rising costs of its aging pipes and roads. When those original bills come due, the town has only one lever left to avoid bankruptcy. It must permit and build another new subdivision. This is the specific requirement of a Ponzi scheme, continually recruiting new development money to pay off the obligations of the old development. Eventually, the sprawl runs out of space. In Marone's home state of Minnesota, we can see exactly what happens when that growth cycle reaches its natural end. Out of Minnesota's 854 small cities, roughly half are now entirely financially dependent on state transfer payments to survive. Decades of endless growth simply delayed a mathematical reckoning that many of these municipalities can no longer avoid. This chart shows the life cycle of a typical subdivision. A massive revenue spike in year one is followed by decades of flat, stable cash flow. Then the crash happens. When the infrastructure rots, the replacement bill sends the town's cash flow into deep negative territory. The bill falls to a future town council. They inherit rotting pipes and a town with no more land to sprawl into. They are left with three grim options: implement massive tax hikes, execute brutal service cuts, or declare municipal default. This was never a malicious scam. Nobody intentionally engineered a pyramid scheme to defraud the public. The trap emerged because mid-century accounting practices made endless growth look mathematically free, and free growth is a hard thing for any local government to refuse. But the ledger doesn't forget. Right now, a town council is approving a brand new subdivision to cover a budget gap created by the very last subdivision they approved.